Do a countdown. We'll see. Oh, we're live. Okay. Welcome to the very first live stream AMA. This one is with GammaSwap. So today we're joined with. There's a preposition there that I'm getting wrong. Devin and Daniel. Daniel is the CEO, and Devin is one of the co-founders of GammaSwap. Why don't you guys describe GammaSwap in your own words? Devin, we'll start with you.
Yeah, so GammaSwap was really interesting. I was previously at Figment. They do a lot of the proof of stake infrastructure, and so I was at a hackathon, and I was responsible actually for a bounty. And I thought GammaSwap was really cool because I had been LPing for a while and kind of stopped, unless it was on a new chain or like a new protocol, maybe that was doing really aggressive like liquidity mining incentives. So I thought that was interesting. But then when I learned kind of like on the long-term potential what GammaSwap could be, that's when I feel like I'd regret it if I wasn't full-time. But yeah, essentially what GammaSwap is it's a way to short liquidity on any AMM and any LP pool. So why someone might want to do that is if you expect impermanent loss to be greater than the swap fees, and you can take the opposite bet of that, and basically your permanent loss becomes your impermanent gain. So it's a way to get a positive EV trade. And then the cool thing is that if you change your margin or your collateral ratio, you can essentially get leverage. So it's not necessarily the same leverage through the curve, but you could get 5 to 10, maybe even higher leverage, depending on the volatility of that underlying pool. And then the ability to basically trade options on any token is really cool. And then I think the long-term potential is just to correct mispricing in AMMs, because AMMs, you're essentially selling volatility, but no one can buy it. And so essentially the price of it becomes really depressed, and it's hard for new people to add liquidity. So we're hoping that by passing on some of the borrow fees from those longing volatility or longing gamma through the AMMs, we can also attract more liquidity or more TVL to these different AMMs.
Okay, so I'm going to have you go through that again very slowly and ask you a bunch of questions on the way there. So one of the things that you said that was really interesting to me is that utilizing gamma in some way allows you to reverse your impermanent loss, such that whatever impermanent loss you would have made, you can have that as impermanent gain. So if you think you're going to lose in your LP to impermanent loss, which means that your impermanent loss is going to be larger than your swap fees, or you're going to have more loss than you would have gained from swap fees, then you can effectively take the opposite bet and like short the IL in some manner of speaking and get some impermanent gain. Before we get to why that's possible, can you explain what gamma is and how it plays a role in all this?
Yeah, I can let Daniel take that one.
Please do.
He's the more quantitative one.
All right. So gamma is defined as the second derivative of the price of the function of the value, the calculus the value of the option with respect to price. So there's another term called delta that everybody talks about. Everybody wants to be delta neutral, which means that if the price changes, they don't want to lose money. They just want to make money without having any risk. So gamma is how much that delta is changing as the price changes. Right. So your delta is increasing or decreasing as the price changes. That's what the gamma is. So delta is the change that you're experiencing when the price changes of the risky asset. The gamma is how much that change is increasing or decreasing as the price changes. For example, a product that's like Ethereum USDC, for example, that would be a Delta 1 product. So Delta 1 would mean every time that Ethereum goes up by $1, your account goes up by $1, assuming you're holding 1 Ether. If it has a gamma that's a positive gamma, that means that if the price goes up by $1, then Ethereum is going to go up by more than $1 on the next price change.
So gamma is the rate at which the price changes with delta.
Right. The rate at which the delta is changing. So
the price.
So the rate of increase of the delta.
Okay. Yeah, the rate of increase of the delta is the gamma. Got it.
Yeah, right.
Yeah. So, or just essentially can be thought of as like the volatility. Because as that delta changes, it's because of the volatility of the pair. So to short gamma would essentially be to short volatility, which I think is what you probably want as an LP in AMM right now, because that means that, yeah, hopefully the volume is going to be higher. And then to long Gamma is hoping that the volatility is going to be higher than any of that volume or the swap fees that are being accrued on that pair.
Can you say that again? I think I may have misheard you.
Yeah, no, I was saying it can be thought of in a lot of ways as like just volatility. So if you're an LP and an AMM right now, you're hoping that volatility is low, and the swap fees are higher than the volatility loss you're experiencing, since you're essentially like short volatility. And then if you want a long volatility through something like GammaSwap, then you're hoping that volatility is going to be higher than the volume or the swap fees that that token or token pair would accrue.
Okay, so we sort of have like a catch-22 here, because volatility also probably means you're generating more swap fees, and low volatility probably means you're generating fewer swap fees. Now, there are some exceptional cases here, specifically with like stable swaps, but you're suggesting that gamma itself is semi-representative of volatility. There is a direct relationship between gamma and volatility, and so if you want to long volatility, you can effectively long gamma. If you want to short volatility, you can short gamma. And my understanding is that impermanent loss generally comes from some outsized volatility.
Yeah. I'll quickly touch on that and I'll let Daniel add some color. So Daniel's done some back testing and about the correlation between volatility and volume in AMM, so it would be helpful. I guess what I would say is that I think, yeah, maybe in like a really large liquid pair, that correlation is closer, and obviously depends on the tokens that compromise the pool, like ETH, USD. The volatility between those is obviously different, while the volatility between like something ETH and BTC might be a little bit more correlated. But I think particularly for like altcoins, it's kind of like, like penny stocks and traditional finance, where that correlation is the weakest. They're often, because, they have a low float and maybe not many people are buying and selling that token yet, they'll have really high volatilities and low volume. So I think GammaSwap is something we see as potentially being a huge value add for like new projects trying to attract liquidity, and hopefully with less like liquidity mining incentives, because often what we see is, especially for new projects, those liquidity mining incentives are to compensate the LPs maybe for that impermanent loss that they might be experiencing with that volatility. So we're hoping that, yeah, this could lead to potentially more sustainable like liquidity in DeFi, especially for new projects that are coming on board. And yeah, people don't have like any ways to hedge their exposure to providing liquidity to that new project.
So this is a pretty exciting product, but let's dive into the math. So Daniel, I've heard that you have done some math and have some math to show us. And as the man known as the calculator guy, I would love to see it.
Okay, I'm going to share the spreadsheet that's showing the payouts of GammaSwap.
Okay. Yep. Let me know when you have clicked present, and I'll bring it up.
All right.
So one of the questions I have while we wait is, with GammaSwap, let's say that someone imports some sort of LP with you guys. Are they forfeiting the emissions to that LP, or will they get the emissions but also be short on the impermanent loss?
It depends. So we're working with some projects to be part of their liquidity mining incentives, and we're hoping that as GammaSwap gains more traction, other projects will put us on their gauges or through governance, or that some projects will have some token incentives. They'll have some liquidity maybe on like a sushi swap or balancer, and then on our pool on top of those AMMs, and put some emissions towards both. But yeah, potentially that may be a reason, because technically the yield in our platform is always going to be greater than or equal to the yields in the underlying AMM as an LP, because you earn all the yield from the underlying AMM. So you'd earn the impermanent loss, well, you'd earn the swap fees minus the impermanent loss, and then you also earn the borrow fees in our platform. So the only extra risk you're taking on is the smart contract risk, but you also earn an extra yield. And then the only exception to that is maybe there's liquidity mining incentives for another pool, and that those aren't being distributed to GammaSwap. So that may be a reason why, besides the smart contract risk, someone wouldn't want to provide liquidity, or there'd be a better opportunity somewhere else.
So I think I understand. Let me just make sure. You'll see that I do this a lot, just to re-clarify and re-clarify. So someone could take their LP and they're still going to be getting all of those swap fees because that's the LP. However, the impermanent loss, which I wish there was a neutral way of saying impermanent loss because it could also be like positive, that's going to be subtracted. So if the impermanent loss is negative, like you're losing money in that LP, you will get a minus negative, so you'll actually have that as an impermanent gain. So you'll have the swap fees plus whatever the loss would have been reversed.
Well, I'm saying actually as an LP provider. So I'll say the P&L both. So for an LP provider in a normal AMM, it would be swap fees minus impermanent loss, or plus liquidity mining incentives. GammaSwap, it's swap fees as an LP provider minus impermanent loss, plus the borrow fees that the people borrowing or shorting that liquidity on the other side to long volatility are paying to you. And then if there's any liquidity mining incentives, you might get those. Obviously, at first, we might not be as part of many gauges until we gain traction. So that might be a reason why someone wouldn't want to provide liquidity. But if you are like not including liquidity mining incentives, the yield in GammaSwap should always be equal or higher to the underlying AMM. And then on the opposite side, for those longing Gamma or shorting liquidity, it's impermanent gains minus the swap fees that LP position would have accrued if you were LPing, minus the interest rate being charged to borrow that liquidity, which is dynamic. So if there was a lot of people, longing volatility or longing Gamma, then that interest rate could be pretty high.
All right. Now, it looks like Daniel's having some issues here with his screen sharing.
Yeah, can you guys see my screen or
No,
no?
we can only see like a black rectangle.
Oh, all right.
So when you click present, you may be doing this, but you have to click on the specific window that you want to be sharing.
No, yeah, I'm clicking on that one, but everything's black.
Oh, well,
Devin, do you have? Maybe it's because I'm on a Linux machine. This is a browser.
That could be it.
Yeah, Devin, do you have a Mac or Windows?
Yeah, I do have Mac. Let me pull up the sheet.
Hey, we have Linux, Mac, and Windows all represented here. So I do want to break that down a bit more when we have a chance, because it looks like there's going to be two offerings here: people who are short on Gamma, and then people who are not short on Gamma but participating in GammaSwap in some other way that are somehow earning fees from the borrowers. So will there be lenders who are lending their LP, or will they be lending something else?
Lenders are lending their LP tokens, so they're pretty much depositing liquidity the same way as if they were providing liquidity into an AMM like Uniswap.
Sure.
Mm-hmm. And when people are borrowing the liquidity out to create an option payout, they're pulling out the reserve tokens of the AMM, and the LP token pretty much becomes a synthetic token. That from the point of view of the LP, he still owns that token, but that token doesn't exist anymore. Instead, they are reserve tokens. And as the price changes, because of what impermanent laws, so the reserve tokens are worth more than the value of the LP token as the price changes. Sure. That difference in price, that's what's the return of the borrower, of the person.
Oh, I see. So you're literally shorting the LP token.
Right. Yeah, literally shorting the LP token.
I see. Okay. Now this also opens up the potential for some actual delta neutral strategies in the future, where you have the LP token and then you have a synthetic version of the shorted LP token. But I see Devin has it up, so I'm going to go ahead and bring up his screen here. All right. Yeah. Please walk us through this.
Oops, okay. All right. I can describe it. So it doesn't show the charts, or can you see the charts?
Yeah, it was showing the charts before. Let me reshare my screen. Sorry about that.
It's all right. This is the first StreamYard ever, so there is plenty of room for
okay. Cool. I think it should be working now. About to share it. Okay, wait. Now it disappeared. Let me try it on the same screen. Okay.
let's try that. Hey, I see graphs.
Okay. Yeah, here we go. All right. So this is the Uniswap V2 long. Which one do you want to start with, Daniel?
Let's start with Uniswap V2 long because I think
Okay.
that's the easiest to think about and the simplest one also. Yeah. So well, one of the cool things about this, I mean, as you can see, the payout is similar to an option payout where it's so if you're going long, so the price is going up, going the right direction of the chart, for example, then the value of your P&L is going up. So that return of your P&L there, it's skyrocketing. If it's going down, then it's pretty much almost flat. So you're not losing much if it's going down in price.
So where is the where I see the long ETH in GS, which is the orange, but I don't see the spot ETH.
Yeah, well, the spot ETH would be the x-axis, what it looks like.
I see. So that's the price change. So as the price goes,
yeah. So as the price goes up,
down, right? Okay.
Yeah, the return of the well, this is like a call option return. So the return of the call option goes up exponentially. So it's reaching in this case, it's reaching around, I think, if the price goes up like 800%, this is reaching somewhere around, providing a return of around 44,000%. No, 4,400%, not 44,000. Like around 4,400%. So it's a 44x return.
Okay, but if the price goes up, maybe a little bit more modestly to, let's say, a 22% increase, it's still going to look semi-linear.
Right. Yeah. So if it goes up to 100, then you're getting somewhere around 300. So it's like a 3x return. And that depends on how much margin also you're providing. So because you're locking up more capital, the more margin you provide. So if you lower the margin to a different level, like say at 3%, for example, like we put in margin at 5%. So you lower it to 3%. Yeah. So then at 100%, you're more like around 5x or so return relative to doing spot ETH. And the benefit of all this is that you can get these outsized returns, which are similar to leverage returns, without having to worry about liquidation risk. Since if the price crashes, you're not going to be liquidated.
Why is that? What's going on there?
Well, it's the same thing as an option. The call option, you buy the call option, you pay the premium. Now, if the price goes up, great, you make a lot of money. If it goes down, it doesn't matter because you're independent of delta risk. Your delta goes down to zero as the price.
Right, but if you buy a call option, that call option can expire worthless, and then you effectively purchase something.
So the way to think about that in terms of expiration is the yield that you're being charged every day. So it's a continuous yield. So as the yield is being charged, your collateral, your margin that you provided, so the extra collateral that you provided is being eroded. So once it gets eroded below a certain level, then you're subject to liquidation at that point. So that's where liquidation comes in. That your loan was underfunded at that point because of the yield ate up all of it. But it's something that is independent of the price change. So you don't have delta risk in that regard from it. It's all it's interest rate, so it's like a time risk only. So it's dependent on time, how much time has passed over time. So that's where that would be the analogy of it with expiration dates.
So what is the margin here denominated in? What are you putting up as collateral against?
Well, so in this case, we're doing ETH USDC. So you're putting up as collateral USDC. So in that example, you're putting up $10 of collateral. And if it goes great, like say if it goes 8x, then it becomes 44. Well, in this case,
8x. I think everyone's going to be happy for a lot of other reasons.
Right. Yeah. I mean, this is I think this is very significant for something like a long tail asset, like a low market cap coin that it's not very popular, new project, right? Huge potential if it goes well, right? And also for that reason, also. If you're a liquidity provider in these pools, I mean, I'm pretty sure there's going to be a lot of demand for this stuff in the low market cap coins. So then the yields would rise up significantly enough that they will compensate the liquidity provider. So then it makes it profitable to provide liquidity in these low market cap coins also that are like new projects.
Okay, so you're saying it makes it profitable to provide liquidity. guess I'm still missing something here. So if you're using USDC as collateral, where does the liquidity come in?
Oh, right. No. Okay, so I mean, this example we're using USDC. So because this is supposed to be based on a pool that's ETH and USDC. So
Right.
it could be any token pair. It could be a ETH BTC or a new coin A versus new coin B. So then the collateral will be new coin B. And actually, you can choose which one you want it to be. You want it to be a coin A or coin B. And in theory, the smart contract is actually able to handle both tokens at the same time. You want to provide them both as a collateral. But for the simplified version that we're launching with, we just want to use one token to make it easier for people to think about all this. Since it becomes more analogous to buying an option where you just buy some money, like put some money in, and then you get this payout function.
So the mechanism is you look at an LP that you're interested in, as an example, ETH USDC. Now you enter with one of the two sides of that. In this case, we're entering with USDC. And then what happens there? What is borrowed against that? Is the LP borrowed against that, and then the LP is shorted, and that is how we get the value of the sort of the synthetic derivative?
Yes. So the LP token is borrowed, and the funds that the LP token represents, the reserve assets, they're pulled out of the CFMM. So they're pulled out of the AMM, and they're held as collateral for the position to make sure that the position is always collateralized, so the liquidity provider never loses its funds.
Right.
So now the price changes. Those reserve tokens are able to buy more LP tokens, or be deposited inside the liquidity pool for more LP tokens. Now the borrower only owes the LP tokens that he borrowed. He doesn't owe any more than that. Plus an interest rate charged on it. So whatever difference that remains, that's his profit. And that profit is calculated on column H there, which is based on the difference in price between what the reserve tokens are, column D and E, as the price changes, and what the value of the static portfolio is of when he pulled out those funds are, which is column G. So that's why he gets that like cool exponential payout as the price changes.
Okay, so now go ahead.
No, I was just gonna say, like, I think we're most excited about like altcoins because right now there's no way to trade any perps or types of options as altcoins. Like, this is a way to trade it on ETH, of course. And the cool thing is that it might be a better hedge than an AMM since the delta is changing along with the LP position, the underlying AMM, unlike maybe a perp where the delta is 1-to-1. But like Bonk's been getting a lot of attention lately. And in this week, it moved like 3x. So if that was to move 3x and you had, 5 to 10x leverage in GammaSwap, that could be interesting for a lot of people. The cool thing is that it's pretty hard to get liquidated, even with something like a 97% LTV ratio, so the 3% margin where you have a lot of leverage here. With our calculations, the max APY that will calculate an interest off is 1,000%. So after that, the interest rate stops changing. But even with that, it would take 24 hours to get liquidated with something like a 97% LTV ratio. So if you wanted to get like leverage on Bonk, you could, put up like a 97% LTV, maybe the APY and the underlying pools 100%, and then you have, a week, a couple of weeks without even having to top up any collateral. And if the price moves like 2 or 3x, you're getting like a 10 or 15x move, depending on the call or the put, what way you have. If you don't know what way it's going to move and it's going to be volatile, then you can just buy a straddle, and you might not get as much leverage one way, but you can profit off the volatility for any altcoin that you want.
Just to correct one thing. So at 1,000% APY, that comes out to be about 3% every day. So now something having 1,000% APY would calculate to an implied volatility of around 800+%, depending also how what is the drift of the asset also. But that's a ridiculously high level of implied volatility. There's not even like the new tokens have that level of implied volatility. So it's unlikely that you're going to see something like that persist for a long period of time, because it would attract a lot of people to provide liquidity in these pools. And also, since you have the ability to be able to short the price of the token through this platform, then the risk of providing liquidity is lower also. So for that reason, we don't think something like 1,000% APY would persist over time, because it would incentivize a lot of people to provide liquidity. But at 1,000%, so that comes out to be around 3% every day that you're being charged. So say between 8 hours, it would charge you about 1%. So you could do away with having a 3% over-collateralization ratio, like 3% margin. So that would give you still 8 hours before your position is subject to liquidation. Like I said before, 1,000% is ridiculously high, right? So, and there's still 8 hours if someone tries to do an attack like that. So if you do more than that, say like 5%, then then the time span for liquidation gets even longer and longer.
So there are a few things that I still don't quite understand, and I apologize for the slowness of learning this. First one is, if you are shorting the LP, why is it that especially if you're shorting it against, let's say, USDC, why is it that as the LP increases in value, which looks like as ETH increases in value, you are also gaining in value? Shouldn't you be decreasing in value? Shouldn't you be in the red?
No, because that's the source of impermanent loss that everybody complains about. But that is the price of one of the tokens is increasing. The quantity that it should compensate you to keep track with the original portfolio is also decreasing. So
okay. So you're saying that the quantity of the LP token.
Yeah, the quantities inside the LP token are decreasing.
Right.
So that's why that's the source of impermanent loss. It's not really keeping track of the price increase that it would be if you had pulled the tokens out. So that difference is what people refer to as impermanent loss. That's your profit for you as a short of liquidity. And and in this example, we're weighting the tokens to one side, so you get more like a call option payout. If you just kept it at the same price, so you never rebalance the tokens, then you pretty much have a straddle. So you're indifferent whether the price goes up or down. So we don't have a chart of that actually here, but you can think of it as the impermanent loss curve just inverted, and that would be your payout function. Inverted and leveraged actually, because you don't have to provide that much liquidity. Like in this case, for example, that's a $200 portfolio, like at the money. So like when you open the position, it's $200, and this position is being opened with only $10. So also, if you want to think about hedging, if you want to hedge your liquidity or provision exposure, you can hedge this stuff with only $10.
That becomes pretty interesting. Before I ask you about that, the next question I have is, you were mentioning if the emissions are something like 1,000% or 600% or some ridiculous percent, that's effectively pushing you closer and closer towards liquidation. Now, why is that? Are you talking about emissions from swap fees only, or emissions being incentivized from like a DAO or like, farm yield rewards?
No. So there's so in the platform there's two sources of emissions. There's one is the swap fee, people trading the AMM, and the other part is the interest rate that the GammaSwap is charging to liquidity borrowers.
Yes.
And then if somebody wants to provide a liquidity mining contract for liquidity providers, that would be outside of the platform. So it would be independent of the platform. But
so the people
Go ahead.
The people shorting liquidity wouldn't be responsible for paying those liquidity mining incentives. That's what you're saying, right, Daniel? It's only based on the APY from the swap fees.
Yeah.
So in the example of like 1,000% APY from swap fees, that's extremely unlikely, even in like the most wild scenarios. But there might be a borrower's interest rate that's incredibly high for one reason or another.
Right. So most likely something like that would be like someone trying to attack it, for example, and the purpose of having this margin requirement be substantial enough that it will take several hours is that somebody has to maintain that attack for that many hours.
Right.
And it actually incentivizes other people to provide liquidity while this person is losing money for several hours, even could be up to a day, for example. And it makes it less likely that they'll be successful at it and therefore not do it.
Got it. Love it. Okay, let's talk about the hedging with minimal cost. I think that's something that my community is in particular very interested in. So let's use the ETH USDC as an example. It's a very, very popular LP. We won't necessarily get into Uniswap v3 yet. That's a whole other bag of worms. Let's just talk about basic LP. You have USDC, ETH, maybe AVAX, whatever it is. In what way does GammaSwap or shorting Gamma, or not shorting Gamma, shorting volatility, or shorting these LPs, how does that allow you to neutralize your delta in some meaningful way?
All right. First, when you're providing liquidity in an AMM like Uniswap v2, you have you have actually a gamma exposure. You're selling gamma, so if the price changes, the value of your portfolio is not going to decrease 1-to-1 with the price of the risky asset, like a Delta 1 portfolio, right? It's going to actually start growing exponentially, and that's the source of that exponential payout there. So for that reason, if you use this product, you can hedge better that exposure because you also have convexity in your in the returns of your portfolio, the same way that you do when you're providing liquidity in the AMM. And another advantage is that since the whole position is leveraged, well, I mean, it has to be leveraged in order to be able to do it. So because it's leveraged, then you can you don't have to open up a position that's or commit as much capital as you do for providing liquidity in order to be able to hedge that exposure. You only have to commit a small percentage of your capital to hedge your exposure. Like, for example,
do you have any examples where you could show us sort of what a hedge would look like?
I can sort of show you with this stuff. If you go to the Uniswap v2 short tab.
Yeah, give me 1 second.
Yeah. All right.
There we go.
Yeah. So, for example, all right. So on the first column B, that's the price change. Column D and column E are the value, well, the quantities of the reserve assets in the DLP represents. Column C, no, column B and column E. I mean,
yeah.
So yeah, so scroll down a bit. Yeah, scroll down even more until you get to the green stuff. Yeah, there you go. So when you open the position, you're at the green line. So you're $200,
Mm-hmm.
right? And you're going to over collateralize this loan with $14 in this case, right? So you have sort of like a put option on ETH that's cost you $14.33 to open up, which is you're not losing it. It's just you're putting it as collateral there. So if you want to close it right away, then all right, you get your $14 back. There's no problem, right? Now, if it goes up in the other direction, you're losing some of your $14. You're losing now $1, $2. As the price goes up, it's $0. Not losing much because it's like a put option. So if the price goes up, right, you're losing some of your premium, but it's not you're not losing like Delta 1 change.
And column B is the price change of the LP or the price change of the asset, in this case being like ETH?
No, column B is the price change of the asset. So 10% would be Ethereum moving up 10%.
Got it.
Maybe 9% would be Ethereum going down 9%.
Sure. Okay.
Right. So now say the price goes down 18%, for example. Right, 18%, and that means that the value of your portfolio went down by in this case went down by well, so the LP risk, the impermanent loss, actually is much lower than that, but the value of the portfolio went down by in that case it looks like it went down by around $20, and the profit of your put option is around $3.49, but that's because that would be hedging the whole value of the portfolio. That's not really impermanent, what people refer to as impermanent loss, because when you're holding impermanent loss, you're holding the value of the actual stuff. Like, for example, if it goes down 50%, the impermanent loss is around 5.7%, for example. No, right? You understand what I'm saying?
Yeah, I don't see the 5.7%, but I agree that
it's not there. But it's like if it goes down 50%, it's 5.7%. If it goes up 100%, the impermanent loss is 5.7% also. So in this case, it's going down well, in this case, say it went down. Say it goes down 50%. So
I see. So here you're not hedging against the delta relative to fiat. What you're doing is you're hedging against the impermanent loss as if you were holding those two assets.
Right. Yes. Right.
So you're effectively like if you wanted to hold ETH and hold USDC and get a yield on those two things separately, but the only way you could do that is through an LP, this allows you to do that to some extent while also hedging against impermanent loss.
Right, yes. I mean, in this case, this portfolio is not, that position is not optimized to be able to hedge the whole price move. But like I was saying before, the impermanent loss, if it goes down 5%, the impermanent loss will be around 5.7%.
50%.
Well, if the price goes down 50%, the impermanent loss is around 5.7% of the LP position. In this case, but your put option is making around 110% return. So now
right, $12, and now it's worth $15.9 more.
Yeah, so you have $15 more. So that's
and $15 would be about roughly 7% of your initial $214.
Right. Yeah. So that's covering your impermanent loss in this case. I mean, that's more than covering the impermanent loss, I think.
Right. So what's that negative 2.2 on column J?
Negative 2.2 on column J. Oh, that's the leverage of the position relative to just having spot. So
okay.
So you were trying to.
Why isn't there a column of like your P&L relative to impermanent loss? Like, if you're losing 5%, but you're gaining, I guess, like 6%, there should be a column that tells you what the differential is.
I'm sorry. Can you say it again?
Right. So if we know that like impermanent loss is taken away 5%, but this quote unquote put option is giving you 6%, there should be a column that tells you, at what percentage, that 6% minus 5%. What you're left with if you're
it's just that we didn't make this spreadsheet to try to show hedging permanent loss and that stuff. We were trying to do it to hedge show the option payout.
Ah, okay, I got it.
This is not too much for that. But like if you're trying to hedge the permanent loss, you would have to have a position that's equivalent enough to the amount that you want to hedge. Like in the small changes, for example, when it goes down only 10%, the impermanent loss is very tiny, less than 1%. But your position is making like around 11%, so you're making like 10x the impermanent loss change. So if you want to hedge it completely, then you have to open up a larger position, but it still doesn't have to be the same size of your position. And a lot of the stuff with impermanent loss is that you can actually hedge it by just borrowing the asset. Like instead of actually you buying Ethereum and USDC, when you're trying to measure everything in terms of USDC. Just borrow ETH also based on USDC. So now you have ETH as borrowed, and you're providing ETH and USDC, and then you just open up with like around $14-20. You can hedge out the whole thing. You don't have to worry about the interest rates that you're paying on the lending platform. And
I see what you're saying. Right? Yeah. So borrowing half of a side of a volatile LP, which is also sort of known as pseudo delta neutral. The reason why that sort of has sucked historically is because of the impermanent loss that you can get, and then you have to pay back more than you've borrowed. A variety of different issues can arise there. But what you've sort of given me the idea of is if you use GammaSwap to hedge the impermanent loss, then you could still short the volatile side. Let's say you're doing maybe something a little bit more volatile. I can't think of any asset that. Let's say there's a bonk USDC LP as an example, and you're like, bonk's not going to go up forever. So you short bonk on some perpetual exchange, but you're also using GammaSwap to neutralize the IL. So you more or less know how much bonk you need to short with some degree of protection against that IL. Whereas if you just borrowed the bonk to enter in the LP, and then there's a lot of IL, you might leave with far less bonk that you have to.
Yeah. Chances are too, I think for most altcoins, like there's no way to even borrow the altcoin. Because a lot of them are required by oracles too. So I think that's been a huge problem with new projects is people can't not even pseudo delta neutral like hedging, like no way to hedge, which I think makes it difficult to track liquidity, and where a lot of liquidity mining incentives come in to compensate some of that risk, so that there's liquidity to trade with.
Yeah, I mean, there's also this also makes it possible to be able to create a lending market on altcoins that, like Esteban was saying, that don't have an oracle, because like the problem with a lending market is that you provide some collateral and then you borrow the asset based on just that collateral that you provided. But then if the asset price changes, then you don't have enough collateral to buy back the asset.
Mhm.
So, but with this stuff, since you can insure the price of that asset by having something like a put option on it through GammaSwap, then you can actually have protection on that asset. So even if the price goes down substantially, you'll be compensated for it, and you won't take you won't lose. I mean, the interest rate would probably just be high, but
Or if the
you
price
can,
of the asset goes up substantially, because if you're in an LP and the price of the asset goes up, then you're going to exit that LP with less of that asset than you entered, but you still have that debt. So you would have to go back and buy back some more of that volatile asset.
but not wait. Can you? So you're talking
Yeah,
about
let's say you borrow 10 bonk as an example. I don't know why we're using bonk, but let's say you borrow 10 bonk and you put it into a bonk USDC LP, and the price
Mhm.
of bonk goes up dramatically. So now in that LP, you only have 5 bonk and X amount of USDC. So when you exit, now you have to repay the 10 bonk, but you only have 5 bonk. You have to take your USDC from the other side and then go buy some more bonk.
Right. So yeah, so that reason you can buy a call option too, is to hedge that the price upside.
Okay. So I see. Okay. So you can't hedge either direction. You have to hedge directionally based off of your perception of where the price is going to go.
Well, you can hedge
You,
both sides if you want. You can have something like a straddle, and then it hedges
right.
both sides.
Yeah,
Okay.
the default of like x times y equals k, like
Mhm.
AMM, is for it to be a straddle. So we're going to give people that option. Essentially, the UI we want to come out with is really simple, so people will choose call, put, or straddle. Uh, and what we realized while developing was this is when you change that collateral ratio, you get more of something like a call or put, which I think just gives people more optionality. But the default in actually the regular 50-50 type of like collateral loan is the straddle.
I would love to see some graphs of all the different options that one person could have, and some projections and sliders and things. Okay, we're on low on time. I want to see if there are any questions. Please type them in the chat for the last few minutes here. But aside from all this cool math, what else does GammaSwap have going on? Like, when is the launch going to be? What updates do you have? When can I play with this?
So we have a version on our test network. That's the first version that we launched with. I mean, yeah, it's on testnet, but the main purpose of that was to see how people responded to the user interface and get an idea of how we should develop the user interface so that it's easier for people to use. Like, I mean, in my case, like I always use a spreadsheet for almost all type of trading. So, but for other people, it's not easy to visualize. Like people say they like Robinhood. Like I hated Robinhood because it doesn't tell me enough stuff. So, but yeah, for other people, it's too much. So we're trying to simplify all that and trying to figure that out. So that was the main purpose of the test net that we launched. And but a final version that we're planning to go with is going to come out in we think early February, sometime around there. We're currently going through audit. The audit is going well. Haven't found anything significant. So we're expecting for it to come out around early February, and then after that, we're going to start launching other products too, doing other types of AMMs and potentially debt market and vaults for managed strategies, managed liquidity provision, which opens up also interesting opportunities in different types of structured products, like say having like spreads, for example, like you have in traditional options, calendar spreads or just a strike price spreads, the different types of products.
All right, and can I show the testnet really quickly so we can sort of get a sneak peek at it?
I stopped sharing.
Okay, all right.
I have like a few things available.
Do you want to share, or would you like us to share?
I mean, I'm sharing already. Here we go.
Okay, great.
So I think this also sort of illustrates what people might be curious about.
Yeah, that's more like say you have a straddle, for example.
Right.
That's what it looks like.
Awesome. So I am looking forward to this. Who are your partners? Do you have any partners right now? Are you working with any farms, LPs, or anyone who's like rearing to get some gamma neutrality?
Yeah, we're going to be starting to reach out to new projects to hopefully be part of their gauges, or when they release a token, like new liquidity incentives. Nothing committed that we can reveal yet, but we are talking to some large protocols. So we kind of start at the protocol level, and then or like AMM partnerships, and then after that, we're going to be looking more at like individual projects. But yeah, I think liquidity incentives will attract even more liquidity to our platform, which will be awesome, and then make it, less of a more of a no-brainer. Once we're successfully audited and people can read our contracts to provide liquidity in, and then yeah, that won't make as much of a difference to the people longing volatility or borrowing that liquidity. Except now they'll have more liquidity to borrow from, and if that TVL is higher, that interest rate should also be lower. So it's also going to be a better scenario for them as well.
All right, perfect. Any final thoughts, final words?
I'm just happy to be developing this product, and there's a lot of things that I think are very interesting to do that you haven't seen in traditional finance, just because the technology doesn't allow you to make it. But with this stuff, this type of technology, you can actually create all kinds of different things that didn't exist before, and create a more robust financial system also. Which is more inclusive for lots of other people too, since it makes capital raising much easier and less risky.
New financial primitives. I'm into it. I don't know if you guys saw yesterday, there was a lot of news about Ondo doing USTs, not that UST, guys, don't get freaked out. But US Treasuries on chain, and everyone's like, okay, cool, but it's gated behind like $100,000 paywall. That's like the lowest buy-in. You have the KYC. Then today, I forget who it was, they were saying like, yeah, well, we're going to do it permissionlessly. So, and for that, I'm super excited. I think that'll bring a ton of money into DeFi. All that is to say is the more financial primitives we have in this space, the better. And soon, I think, we'll become more robust than TradFi, at least in terms of optionality, directionality, and what you can do with your money. So thank you guys so much for joining, Devin, Daniel, and guys, go check out GammaSwap. Join their Discord. Hopefully there's a link somewhere. I'll find a link somewhere. Follow them on Telegram. They're doing something that, from my understanding, no one else is currently doing. And I really hope that there's a way to neutralize the volatility of IL in the future. Thanks again, and have a wonderful rest of your day.
All right, thank you.
Thanks, Steven.